Good evening, everyone. Welcome to our UVA Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Really excited to bring this content to you. We have a really great lineup for you tonight. A lot of great discussion points. This is actually a really well attended class tonight. So I really appreciate you guys taking time out of your busy schedules to join me on a Wednesday evening. And we really want to obviously provide you with a lot of value in tonight's class. Tonight's class is going to be focused in on really supporting you with resources and tools on that journey towards homeownership. This is a very interactive class that we provide to you. Our runtime will take us up to just about the top of the hour. We encourage our class to ask us questions as we roll through tonight's content. So you can either use the chat feature in Zoom or Q&A, and I'll be sure to answer your questions online. We'll also carve out a little bit of time at the end of tonight's class to just pick up any questions that might have been kind of missed. Again, my name is Jason Maida. I'll be your presenter this evening. My colleague and I, Ken, will be answering some of those questions, and I'll be presenting the content to you. I work for an organization called American Pacific Mortgage, or APM. We're one of the top 10 lenders in the country today. And our team specifically focuses in on first-time buyer education. We understand this is probably going to be one of the biggest financial decisions you decide to make. And it's a big deal. And obviously, with the amount of people that have attended tonight's class, you guys understand the magnitude of this financial decision. So I'm sure there's a lot of things you could be doing on a Wednesday night. But the fact that you've kind of devoted an hour of your evening tonight to kind of learn more about home ownership really signifies to me like, hey, this is a big deal. And so, of course, we want to provide you a lot of value in making that financial decision. We've been in partnership with a UVA alum for close to 5 years, and I've got a chance to be on campus and just see the culture of UVA and just get a chance to work with your fellow alum all throughout the country. So as a nationwide lender, if you decide to kind of partner with us on that journey towards homeownership, we can support you in any market across the country. Well, tonight's class is going to focus on a few of the topics that you see on screen here today. So I'm going to walk you through all these different kind of aspects of home buying, which will include, first of all, start talking a little bit about the housing market and what's happening in kind of this world we live in today from an interest rate perspective, but as well as inventory levels with home ownership. We'll do some calculations on, does buying really make sense for me? So I'm going to walk you through a rent versus buying calculator to see, how we can compare our rent situation versus what it could look like from a home ownership standpoint. Give you some ideas and tips around credit, various loan programs that are available to you. And one of the challenges that I always find in home ownership as I counsel clients across the country is like savings for home ownership. And do I have enough money in my asset accounts to get me to home ownership? So we're going to talk about a plan and some documentation for savings. Also spend some time looking at first-time buyer programs that are probably available in your local community. And then one of our more important things that we take you through in our class tonight is just the steps of buying a home. What's the process I'm going to go through? So ideally, after you've attended a class like this tonight, we'll get a chance to get connected and take you through our consultative process to design some home buying options for you. And that kind of starts this like progression of home ownership. And so tonight, before we wrap up to our class, I'm just going to take you through that workflow so you have a really good idea of, hey, what's this going to look like for me? If I'm going to plan on buying a home in 2027 in October of next year, how soon should I start this process and what is it going to look like for me? And so we're going to walk you through that at the end of tonight's class. And again, I'll kind of just finish up our session by answering any questions that our audience has. Again, thank you so much for being a part of tonight's class, and I hope you enjoy what we're going to be bringing to you. Let's launch into our class by first of all talking about, does buying make sense for me? This is a big financial decision, and a lot of our buyers that I work with don't necessarily understand all the benefits that go into home ownership. We know it's kind of the idea of ownership in the country is a big deal, but what are some elements that are going to help me really benefit from home ownership? Well, most of us live in a pretty high cost of living area, which basically means rent's pretty expensive. And so home ownership can maybe control some of that payment for us, meaning that if I have a fixed payment on a mortgage, I don't have to worry about my rent going up every year. And a lot of our clients that are buying in more of a elevated interest rate market like we are in today are going to have the opportunity to refinance their home at some point in time down the road. And this is an asset that we're going to try to buy. This isn't like going out and buying an appliance or a car or something like this. This is hopefully an appreciable asset that as I kind of maintain home ownership, that home will go up in value. of course, as I own that home, I'll be paying down my mortgage payments. So as the balance goes down on my mortgage, as my home hopefully goes up in value, I'm going to have equity in my home. And that really has an opportunity to create generational wealth for families. The next element that doesn't get talked about a lot is tax benefits, the potential tax benefits of mortgage interest on your home. And some of our buyers or homeowners elect to do energy efficient upgrades on their homes. And when they do that, that can create tax benefits for them as well. So a lot of these things I would encourage our class to think about when it comes to home ownership, because really when we consider home ownership, it's not a fair comparison to say, hey, I'm paying $2,500 a month in rent, so I probably need to spend $2,500 in a mortgage, because we want to really put into our calculations all the really tangible benefits that come along with ownership. To kind of help frame that up for you, our class tonight, what I thought I would do is walk you through one of our calculators that's available on our website. It's called our rent versus buying calculator. It's a really easy tool that can help compare side by side renting versus home ownership. Now, beyond this calculator that I'm going to take you through for the next couple minutes, there's some other pretty cool calculators that you can tap into, like our affordability calculator, of course, if you're a homeowner, to refinance, and then various payment calculators. So we've already kind of pre-filled out this calculator just to kind of help keep our class on time tonight. But I just want to walk you guys through this, and I would encourage you to take a look at this on your own time, because we are going to send back all of our presentation material to you tomorrow morning. We're also recording tonight's class, so this will be up on our YouTube channel. You can obviously look back at your notes, share this content with some of your friends and family, but you'll be able to have all these tools available to your at your disposal tomorrow as well. If we assumed that we're going to buy, say, a $450,000 home, the minimum down payment to buy a house is 3% of the purchase price, and that's for a conventional loan as a first-time buyer. During our product segment tonight, we're going to talk a little bit about different programs that are available, but if we make that assumption, that means we'll essentially be financing 97% of that purchase price based upon today's interest rates, which we'll talk about again tonight. And if we use a 30-year fixed mortgage, that would be all into our home ownership payment calculation. But we also want to assume things like mortgage insurance, homeowners insurance, which will vary based upon where I'm buying in whatever part of the country, the property taxes that I pay to my local county assessor's office. Maybe I'm thinking about buying a condo or a townhouse. Then you'll have HOA dues that are part of your payment calculation. And we talked a little bit about tax benefits of home ownership. A lot of us don't think about that, but depending on what tax bracket we're in, that can help improve the benefits to buying. But we also want to consider expenses like the maintenance of my house, how much it's going to cost to sell my house one day. Maybe I'm planning on keeping this house for 5 years or 10 years. Eventually, I'm probably going to have to pay cost to sell my home. And then appreciation of my home. How much is my home going to go up in value every year? Now, it varies in different parts of the country. If I'm in Omaha, Nebraska, that valuation might change different than if I'm in Arlington, Virginia, right? It's just, those are different markets. They have different dynamics. So, you know, that has to be factored into our calculations. But we'll use 3% for tonight's discussion. And then we assume someone that's paying rent around $2,200 a month with renter insurance expense, and then the assumption that their rent costs will go up about 3% every year. Okay. So that goes into our kind of this calculation of this formula. And so we're basically, again, analyzing what am I doing from a current housing perspective versus my projected housing expense in home ownership. And so what our rent versus buy calculator tells us is that after 3 years, we're going to be on the profit side of home ownership, meaning that with our investments of down payment, if I factor in tax benefits, equity appreciation, I'm going to be ahead of the game after 3 years by owning versus renting, which is a really, really great break even. I would want our homeowners or prospective homeowners to at least break even in 4 years or less. So this is working out really good here. Now, where it gets kind of exciting is if we start kind of now panning out a little bit further, let's say after 7 years. Well, after 7 years, now we're $72,000 ahead by being an owner versus renting. And we talk about equity and being transformational for families. That takes your home equity up by $158,000 over that 7-year period. So that's really where we want to look closer into home ownership. And I would encourage our class, when you have some time later on this week or maybe over the weekend, take a look at this calculator, maybe plug in some of your own personal details of rental and, of course, projections around home ownership. Part of our consultation process too, I'm going to take you through this as well too. So it'll be part of our coaching that we do for you in home ownership, but just a great way to kind of like launch into the discussion around home ownership. Now, one of the other things we have to consider is what's happening in the housing market, because our entry point to home ownership will be probably dictated by what interest rates are doing, but also the cost of housing. And, a lot of home ownership is about, where do I want to buy? Where's my location? Well, I know not all of us attending tonight's class are going to be in the state of Virginia. We might be somewhere in the DMV area, or maybe we're in the Midwest or West Coast, wherever the case may be. But every housing market has its own kind of challenges and opportunities. The median sales price right now in Virginia is just over $450,000. We, in across all markets, of course, are in the spring buying season. And believe it or not, it's pretty active in the markets right now. We're seeing a lot of buyers that are engaging, whether those are buyers that were on the sidelines for the last couple of years because they couldn't get into the market, or it's new buyers that are saying, hey, yeah, I'm now want to consider my home ownership options. We're also seeing sellers that are starting to put their homes on the market for a variety of different reasons. Maybe it's just the traditional sale. Maybe it's for kind of financial hardship reasons. But we're starting to see some more inventory come to market, which is something we definitely have needed. We've had some challenges with that over the last couple of years. In the state of Virginia, the median days on market, it's about 37 days. And that's up a little bit year over year. So you are seeing maybe some homes that are a little bit overpriced. And so that might be why they're staying on the market, or maybe they're distressed sales, whatever the case may be. But you look at the median sales price in the Virginia market, over the last 3 years, you see a nice little move upwards. That's obviously not great for us as buyers, because now we're seeing a higher cost of home. But nonetheless, the market is certainly on the improvement side. Our forecast for 2026 have kind of changed a little bit. Obviously, what's happening in the Middle East with the conflict has really kind of changed the perspective on what's happening with interest rates. But aside from that, we are calling 2026 a little bit of a reset for the home buying market. Things will be a little bit more affordable, because we are going to have, even though we're a little bit elevated interest rates, we will have a lower interest rate environment, which will help make things a little bit more affordable for us as prospective buyers. Price growths are not expected to be super huge, very modest growth. In some areas, won't see big jumps at all. We might even see a small reduction in price. There are some states like Georgia, Florida, Texas, Colorado that actually have significant more backlog in supply than what we'd see in, say, our slide we showed you for Virginia. That's where we're seeing a lot of buyers able to negotiate seller credits, reduction in prices. The buyers really have an upper hand in some of those other markets for sure. Inventory is going to improve a little bit in most markets, which, to my point just a second ago, it will give some buyers some leverage. And, there's still other markets, in some of the DMV areas, it's still super competitive. If you're out in California, Bay Area market's really competitive. But I think there are some opportunities in the 2026 market for those that are really financially prepared. Our job is to help kind of coach you up into those opportunities and help you understand what that looks like for you in your respective market. That doesn't have to be a plan that has to be executed on this year. It could be something for next year, but I think there is some opportunities in today's market. Interest rates have been kind of all over the board, and we've dealt with a lot of volatility in the market, even up to today. Some of the general market movers did move the markets, whereas other things are moving the markets. Price of oil has moved the markets. We never thought we'd have to kind of monitor what's happening with oil prices, which I think are just about $90 a barrel today. But interest rates have really flexed a lot over the last 12 months. This peak right here that you see for 2026 is a result of the conflict in the Middle East. Then we saw kind of some declines, and this up and down is some of it's been driven off of on again, off again peace negotiations that has really moved the markets. And aside from that, we're really watching what the Federal Reserve is doing. Kevin Warsh is now taking the helm at the Federal Reserve. We'll have to see what monetary policy looks like. Today, monetary policy includes a goal of 2% inflation for our country, and then really the test of what's happening in the labor markets. You're seeing a lot more layoffs, especially in the tech industry. I think Salesforce has had some layoffs. Meta's had some layoffs. So we'll have to see the impact of the labor markets on what's happening in our economies all across the country. But interest rates will still kind of remain pretty choppy. I think buyers that are thinking about getting in today's market, this isn't probably going to be our forever loan. It's probably going to be a loan that we're going to keep for the next 2 or 3 years. Then eventually opportunities will present itself to refinance that home, which basically means trying to refinance down to a lower rate to help create savings for myself. As we consult our clients, we're going to figure out what the best interest rate option is for you. But different characteristics go into an interest rate. Things like credit score and eligibility for a loan product, the type of program I'm going to do, how much I'm deciding to finance, what my down payment might look like. Maybe I'm going to make the decision to buy down points on my interest rate, which essentially means where I'm putting additional expenses out of pocket in order to bring down my interest rate. And then depending on the term of my loan, that can also influence my interest rate. Generally, the shorter my term is for my mortgage, the lesser my cost is going to be for an interest rate. So traditionally, we're going to do a 30-year fixed mortgage, but maybe I can budget towards a 15-year mortgage. Well, that would allow me to perhaps get as low as maybe a 0.5% reduction in my interest rate. As I get a chance to meet with you for your consultation, we're going to figure out the best product that suits your needs financially and figure out how we kind of really design that for you. One of the things that does go into product design, but also rate selection, is credit score. And so one of the things we like to do in our classes is just to kind of talk through some different elements of credit scoring and maybe identify an area of opportunity for you on your own credit score. Now, every loan product does have a minimum credit score, and we've kind of showcased some of those product minimums here. When we think about credit scoring, believe it or not, there's actually 3 different models to credit scoring. There's auto financing, there's credit card, and credit card is going to show up in most of your credit monitoring tools like Credit Karma and whatnot. And then there's the mortgage model for housing. And of course, since you're going to apply for a mortgage, we're going to use the housing model when it comes to financing. And we do take the middle credit score for all 3 borrowers, all 3 agencies credit reporting. So there's 3 agencies that report out. There's Equifax, TransUnion, and there's Experian. So if your highest score is, let's say, 760 and your middle score is 740, but your lowest score is 720, we're going to take 740 as that middle score for qualifying purposes. That's important to know because that can affect your product, your interest rate, as well as the cost of mortgage insurance, especially if you're going to put less than 20% down to purchase your home. Now, if you're going to apply with your partner, maybe your partner's middle score is slightly lower than yours. Maybe they're at a 720, whereas you're at a 740 score. That might change the dynamic of your interest rate. Other factors that will go into the credit score would include things like past late payments and we'll talk more about this a little bit later, but late payments, especially in the most recent 12 to 24 months, are going to have a really big impact in your score. As I move further away from those events, like a late payment, the better improvement I'm going to have to my credit score. Speaking of late payments, this is a matrix that'll kind of show you how long negative items will stay with you on your credit report. Things like hard inquiries, like I mentioned, late payments. Maybe you've had some public records. This is how long they'll stay with you on your credit file. If you've been over limit on a credit card, that will show up as really a negative item on your credit score. Now, as I mentioned, there's 3 different models to credit scoring. We're going to take now a look at the mortgage model. My hope is that our class will maybe kind of listen to some of this content and say, okay, yeah, there's maybe an area of opportunity for me on my own credit score. And so when we get a chance to meet for our consultation, we'll kind of figure out how we can improve upon one of those areas of your credit score. So 15% is going to be how long have I had credit? So the more mature my credit file is, that's going to obviously help improve my credit score. 20% is going to be around how much new credit am I trying to access and the type of credit that I'm trying to get access to. We really want to avoid opening new accounts, especially in a 6 to 12 month period. And we want to avoid opening things like personal loans. Personal loans can actually drag the credit score down a little bit. And you also want to avoid having hard inquiries run on your credit. I'm sure most of our class knows that. But credit inquiries that are hard inquiries, especially in the most recent 6 to 12 months, can have a big impact on your credit score. In the auto industry and the mortgage industry, there is a rule in place that you can apply with as many lenders as you want in a 30-day span of time. And it's the equivalent of 1 credit inquiry hit to your score. So that's just something to kind of keep in mind as you're doing your shopping in one of those industries. In our process, when we decide to work together for your home buying plan, we're only going to start with a soft credit check. And the reason why we do that is many of the clients that I help educate in home ownership, we're not probably buying in the next couple of weeks or even a couple of months. Maybe it's a next year goal. We want to provide you a roadmap to home ownership without impacting your score. So that's why we choose to do that soft credit check. That's what we elect to do with our clients as we're supporting in home ownership. As we continue around our wheel here, amount owed is going to be around credit utilization. So we're looking at revolving credit. If you're running a bit high in your credit card balances right now, so let's say you're accessing 60 or 70% of your credit card balances, you're probably also seeing some pullback in your credit score. What I would encourage our clients to do is let's start trying to get those balances below 50% of the credit limits. And then the optimal level is going to be to get to 10% or less in credit balances. Now, when we take a look at credit cards, I want to give you kind of a quick tip on how to manage credit card debt, because a lot of people don't realize that the reporting to the credit card companies comes when your 30-day activity ends on your credit cards. So meaning when the billing statement closes or billing cycle date closes on your credit cards, that's when the credit card companies send out your information to the three agencies. So my tip for our class tonight is if you're trying to get ahead of that reporting, try to pay down those accounts or ideally pay them off before the billing statement closes. And then what you're going to do is get a much lower balance reporting out to the agencies, lowering your utilization, lifting that credit score. Payment history is the last component, and it's the biggest weighting to the credit score. It's essentially how have I paid my bills. If I have late payments, they're rated as 30-day late, 60-day late, and then 90+ day delinquencies. The bigger, or more significant number of lates in my credit file, so the higher my late payment is, bigger impact I'm going to have in my credit score. And to my point earlier, especially in the most recent 12 to 24 months. Now, one of the accounts that shows up on credit reports, and I seem to be having a lot more conversations about this as of late, because money student loans, especially in the federal loan space, are starting to come back online with payments. So, a lot of our clients are trying to figure out what type of repayment program they're going to go through with. I want to kind of share with you the kind of visibility that a lender has, or how a lender is going to view student loans, because that's kind of important as we're thinking about your qualifying for home financing. If you're in active repayment today, and let's say you're on an income-based or savings plan, if that payment right now on a $75,000 amount of debt is $250 a month, we can use that right away for qualifying purposes. But what we find often is many of our clients are not in active repayment. Maybe they just are still in deferment. Maybe they're in forbearance for a variety of different reasons. If you're not in active repayment, then depending on which product you're doing, then we're going to have to assess a minimum payment into your qualifying. So for example, if I'm not in active repayment right now and I have $75,000 in debt, if I'm doing an FHA loan, we would take 0.5% of the balances and use that as the monthly payment. If I'm doing a conventional loan, we'll take 1% of the balances, and then we use that as the minimum payment. So depending on what product we're going to select, then we're going to address those student loans accordingly. As we kind of talked about consultations and whatnot, when we go through your home buying plan, we're going to figure out exactly how we need to calculate your student loan payments. You're going to learn tonight a little bit about a debt to income ratio, which is essentially the analysis of your expenses versus your income. And that's where that student loan expense payment gets plugged into that calculation. Now, the reason why we have to do that is because every loan program that we offer as a lender is based upon guidelines that are set, whether that's through government agencies or agencies like Fannie Mae and Freddie Mac. This is our product segment that we're going to do a high-level look at different products that are available to you in home ownership. And many of this concepts or terminology you've probably already heard about before, but I want to kind of tie it all together for you. The first one is a conventional loan. A conventional loan has a minimum down payment of 3% for first-time buyers that goes all the way up to the conforming loan limit, which across the country is $832,750. Now, if you're in a high cost of living market like Arlington, Virginia, for example, then we can go to higher loan amounts like 1.2 million, but the down payment jumps from 3% to 5% if we're in those markets. So that's the Fannie Mae and Freddie Mac product line. FHA is a government insured loan, which is our next product. And that loan amount does change, or the maximum loan amount does change depending on what county I'm going to buy in across the country. The difference with FHA and conventional is that I'm going to see a slightly more flexible, more lenient guideline with FHA. Does have a slightly higher down payment, but a little bit more leniency when it comes to a credit score perspective, and just overall guidelines with maybe ratios or just credit challenges. Now, both the FHA and the USDA product are government insured loans. So they do require residency in the United States to be eligible. So you have to be a permanent resident, unfortunately, to access those products. Whereas on the conventional side, you can be a non-permanent resident and still be able to get access to those lending options. The USDA product is going to be designed for clients that really want to purchase in more remote rural areas. The benefit to use that product is it is 100% financing. So, if I'm looking to purchase in one of these markets, I have to make sure it's USDA eligible. And then I have to meet the income qualifiers for the product. The jumbo loan is not going to be something that probably most of our first-time buyers are going to participate in. It's usually for second and third-time buyers because it does have a higher down payment threshold. There's higher credit score requirements. So it's basically someone that has to go and finance more than what maybe a conventional agency product could offer or support us, just from a loan amount perspective. And then finally, the VA home loan is for our veterans that have eligibility in the VA home loan space, and they have to be eligible with we call it a certificate of eligibility or COE. There is really no maximum loan amount for the veterans, and there's just a lot more flexibility to encourage participation from the veterans in home ownership. So that's a little bit of a look at products for you. And, as we kind of dovetail off of products, I did want to talk really quickly about mortgage insurance. I get a lot of questions about this throughout our day. And I like to kind of share back with you what mortgage insurance is and how it kind of breaks down for you. Depending on what type of product you do, mortgage insurance looks one way as a conventional loan, another way as FHA. So let's look at both different products, and depending on which product works best for you in your financial plan for home ownership, we'll break that down for you in your consultation. On a conventional loan, PMI stands for private mortgage insurance. That PMI calculation is based upon your down payment, your credit score, and then how much you finance. So the higher I can push my down payment, the higher I move my credit score, the cheaper my mortgage insurance is going to be. Well, what is mortgage insurance? Well, mortgage insurance essentially insures the lender if there's any defaults by the buyer. So it basically provides protection to the lender. And it's private mortgage insurance in the conventional space. It's government insured on the FHA side, which we'll talk about in just a second. One of the benefits with conventional PMI is that it has a cancellation option after 2 years. So once I have 2 years in my loan and I achieve 20 to 22% equity, I can apply to have the mortgage insurance canceled. Now, with the conventional PMI, it's not as expensive as you might think. If you're online doing calculations on some of the popular sites like Zillow and Redfin, those calculators might not be calibrated correctly. So you might see a pretty exorbitant MI calculation. But if you bought at 450 as your amount financed with a 740 credit score with 3% down, you're probably looking at about $138 a month. So not as expensive as you might think. But if I can raise that credit score, increase that down payment, that premium gets lower. On the FHA side, and remember, FHA is a lot more flexible with our guidelines, a little bit more leniency, lower credit scores. But the trade-off is it's going to be a little bit more expensive when we center around mortgage insurance. There's monthly MI, which is always calculated at 0.55% of my loan amount. And there's upfront mortgage insurance, which is 1.75% of the total loan amount. And that gets baked into your total amount financed. One of the downsides with the FHA product is there really is no cancellation option. So we're looking at FHA as kind of a short-term solution. And then as I make improvements to my credit or my expenses, maybe I see a little more equity appreciation in my home, then we're looking to try to refinance into more of a conventional product. We've outlined the FHA calculation here. So, the difference again being we have both upfront mortgage insurance with FHA and monthly mortgage insurance. So that's where that expense structure is going to change quite a bit. All right, we're going to talk a little bit about income. And before I jump into it, I just want to make sure, because I know we had some that attended late. Any questions from our class so far? I know I'm giving you a lot of concepts and throwing a lot of information at you, but any questions so far from our group? And you can always just throw your question in the chat or Q&A. And like I said, myself or my colleague Ken will be kind of monitoring both windows. But any questions from class so far? Okay. All right. I'll be looking for that if you guys are typing something out right now. I'll just kind of keep us on track. And so I want to talk a little bit about qualifying income when it comes to home ownership. And before I jump into some different scenarios that hopefully will help kind of understand, maybe how your income plays out in your home buying plan, wanted to also share with you some general documentation that we ask for in the buying process. If you're working for an employer as a W-2 employee, generally we'll ask for the last couple of years of W-2s, 30 days of pay stubs. And then on the asset side of things, depending on what asset you're using for qualifying, we'll probably ask for the last couple months of bank statements. Okay. So I do want to walk us through some different scenarios in home ownership because I get a lot of questions in our classes about different income scenarios and does it really work for me for qualifying or whatnot. And so, a couple of things I want to kind of share with you is one is we do have to verify a 2-year work history. But that work history can include also educational background. So if you have transcripts to verify that, you graduated from UVA in, the fall of 25 and now you're in the workforce, we can use that to help make up that 2-year work history, especially if you're, just getting started in your career. Here's a great example. We have a client from one of our other university partnerships that just graduated 2 weeks ago. and they are moving into their house this weekend in Texas. And we were able to qualify them off of their offer letter, as well as to show their work history between their transcripts and in their new job that they're going to be starting to make up that 2-year requirement. So I share that with our class because I don't want you to think that, hey, I got to be on my job 2 years to buy a house. It's certainly not the case. But if we can have an offer letter that just shows what you're going to be making and we get a good sense of your compensation plan, we can certainly look at that as an option. If you are in a variable compensation position, so let's say you have base salary, but you have some commissions or quarterly bonuses, that's where we need to see a 2-year work history. That's where you'll need to be on the job for at least 2 years, because we're going to do a historical average of those variable income sources to make sure it's sustainable for your qualifying. If you are self-employed, that also does require a 2-year requirement, 2 years of tax filings in order to make sure that it's consistent income that's coming from your business. Maybe you're an hourly employee, you work 40 hours a week, but you have a lot of overtime, shift differential. Maybe you're a registered nurse and you see a lot of shift differential because you work the night shift. That is opportunities to be able to average in those variable sources, as long as you've been within that employer, or in my example that I'm sharing with you, 2 years in the industry. So you don't have to necessarily be with one hospital as an RN for 2 years. You just have to show that position for at least a couple of years. Other scenarios that come up too is like clients that have 40-hour work week jobs, but they also drive for Uber or Lyft on the weekends. If I want to include the additional income, we can do that, but we also have to show that we've been doing both jobs simultaneously for 2 years. Okay, so that's some of the scenarios that come up. And if you guys have a question around income, just drop that in the chat, or obviously any topics that we're talking about. But that's kind of some of the typical things we see in some of our discussions with clients. We also get the question often of multiple jobs. To use the healthcare industry again, if you're working for multiple clinics, for example, if you want to show both sources of income for qualifying for your mortgage, then we have to show we've been on both jobs simultaneously for the last 2 years. Okay. Now I'm gonna go off topic a little bit. I just get a question that came in from our audience, which is, how do you factor in opportunity cost of investing in the market versus putting your money into a house when it comes to the rent versus buy equation? So, I think it just depends in that scenario what your return on investment looks like in the market. And it depends on, I had a client the other day say, hey, you can get 7% in the market on the return. If you look at a 7% return and then your appreciation is 3%, that has to be factored into your calculations. But also we have to look at where you're at from a tax bracket perspective, because if you can diminish your tax liability, that also has to be factored into your calculus as well too. And obviously it also depends on what's your goals of home ownership. Are you trying to create affordability for yourself? Are you trying to create a great return so you have all this equity at a certain point in time? And then are you buying this as a rental property? So there's a lot that goes in that question. I don't think it's just a straight up and down answer to that, but that would be a great opportunity for us to connect and kind of talk about your designs around home ownership for sure. All right. Well, thanks for that question. I appreciate that. We're going to kind of continue with the theme of income, but now I want to talk about income and expenses. So one of the calculations we go through in designing your home buying plan is to look at where you're at today from an expense perspective versus what could it look like with my projected housing expense. And then I want to compare that to my pre-tax income. We call that calculation debt to income ratio. The housing equation takes into consideration principal and interest of the mortgage, my property taxes, my insurance. And as we talked a little bit earlier about private mortgage insurance or MIP, that gets factored into my housing budget. And if I'm, of course, buying a condominium or a townhouse, I probably have HOA fees. So we look at those expenses, we compare those versus the income. And generally, we don't want those expenses to be more than 45 to 50% of your income. We've got a kind of a calculation here on screen of one of our scenarios of someone that's got $2,500 in housing expense, $500 in other debts, and they're making $8,500 a month pre-tax. So that puts their debt to income ratio at 35.3%. Again, the guidelines allow us to go with 45, 50%. The question I get from our audience oftentimes is, well, Jason, what's the target zone of where should I be in debt to income ratio? Everybody has a varying tolerance level of kind of where they feel comfortable with. But I would say 33 to 36% is probably the sweet spot for most. That's kind of in the perfect scenario. But at the same time, we're in a very high cost market in most parts of the country. So affordability is a challenge for most. So we do see debt to income ratios pushing up in that 40 plus range. Again, the maximum is 45 to 50%. As we design your options around home ownership, we're really focused on two kind of important goals. Is this a sustainable plan for you that you can weather the storm of any economic challenges that you face at some point in time? And does it feel affordable for us? So debt to income ratio is just a metric for qualifying. It doesn't necessarily dictate affordability for homeowners. Well, last topic we want to talk about, which is probably one of the most important things that we want to share with you in building a plan. And actually, before we talk about the workflow of buying, is savings for home ownership. And what are some of the assets that I can use that can go towards my down payment and what we call closing cost of buying a house. When you think about savings for home ownership, you have to save up for that minimum down payment that we've talked about, but there's also closing costs, which in most parts of the country, on average, are about 2 to 3% of your purchase price. So that has to be factored into your savings plan. Now, when we think about what assets we can tap into, we can use checking and savings accounts, of course. Retirement accounts can be used. I get the question a lot about 401k loans. You can take a 401k loan against your account. Even though you're repaying your 401k, the payment that you make on that does not count against your debt to income ratio. You can also have family members that are going to contribute towards your home purchase. We call those gift funds. And there is no seasoning requirement for gift funds, but other assets, like, if you put $10,000 in cash in your bank account 30 days ago, in order to use that in a home purchase, that has to be seasoned for at least 60 days. All right. So that gives you just a little bit of context around assets. As we think about kind of building up towards our goals of home ownership, in fact, I was doing this earlier today with a client, is just talk about a simple approach to savings for home ownership. Now, we're going to talk about first-time buyer programs in just a minute or so, but as we think about savings for home ownership, this is a goal for us in the next 6 to 12 months or whatever our time frame looks like. What I would encourage our clients to do is, as we learn more about what our expected monthly payment is going to be for our mortgage, is to start saving like we're making that mortgage payment today. So if today I'm paying $1,500 a month in rent, but after going through our consultative process, we're like, hey, I can afford $3,000 a month, but I'm a little bit short when it comes to down payment for my home purchase. What I would encourage our clients to do is let's start making a mortgage payment kind of like we're actually saving like we're making the mortgage payment today. So essentially, first of the month, I pay the landlord $1,500, but I create that habit of pushing another $1,500 in my savings account. And I do that meticulously month in and month out. By the end of 6 months, I have $9,000 saved just for that difference in outgoing savings. By the end of the year, I have $18,000. That's not including any type of high yield account. So that's a really simple but effective approach to savings for home ownership. We've had several of our clients in our different markets that we support put that into practice, and it really starts to stack up over time. Now, first-time buyer programs can also help you reach your goals of home ownership that much quicker as well, too. Before I talk about the first-time buyer programs, I did have a chat message that came in really quick. Let me just kind of share this back with the audience, which was, what do you mean by cash? Is this literal they won't accept physical bills or just account balance? So it's a little bit of both. So cash meaning if you just put bills into your account in the last 30 days, they have to be seasoned for 60 days, as well as you can't just take cash down to buy a house, like physical dollar bills in hand. So it has to be seasoned in the account. And that's just to make sure that it fits just all the requirements that we have for federal compliance and whatnot. But it has to be seasoned for 6 days, make sure there's no laundering of funds or anything like that. So it just has to stay in your account. So now if it's been seasoned, like let's say you got your direct deposit from your employer, well, we can see that's seasoned funds. That doesn't have to be. We're talking about where we can't trace back the source of where the funds came from. Okay. All right. Thanks for that question. I'm glad we got a chance to clarify that. Let's talk really quickly about first-time buyer programs. There are agencies all across the country, depending on what state you're going to buy in, that specialize to supporting low to moderate income households. And low to moderate is defined differently in different states across the country. Usually a low income buyer is someone that makes less than 80% of the median income. And then a moderate buyer is anywhere between 100% to 150% of the median income. Those income limits do change throughout the year, but there is state agencies, they're called HFAs, that are supportive in every market across the country. In Virginia, We have the Virginia Housing Program that can provide lower cost options for you guys as first-time buyers, as well as assistance for down payment, anywhere between 2 to 2.5% assistance. It's a grant. There's also the Virginia Housing Plus Second program that allows you to borrow 3 to 5% assistance that can go towards your down payment and closing costs. So there's income limits for these programs. We can pass along those income limits to you after tonight's class, but a great tool to help kind of close the gap for what you have in savings versus where you need to get to with some of your goals towards homeownership. And again, there's other programs in different parts of the country. So you may be in Texas and you're looking at some different options. We can support you with resources there, or maybe you're in Colorado or Florida. Doesn't necessarily have to be just in the Virginia market. We do nationally have other programs within APM, like our Pathway program, that's specific to the FHA product. You can get anywhere between 3.5% to 5% of your sales price in assistance. And then our APM 1% program allows low-income buyers. So if you make 80% or less of the median income, if you contribute 2% of your, if you contribute 1% of your down payment mark, we'll match with 2% in the form of a grant from APM. So that's a really great tool to maybe get you closer to home ownership, especially for our low-income housing buyers. So as we get a chance to meet with you and figure out and learn more about your financials and how we can best support you, we're going to figure out which program can match up best for you in your path towards home ownership. Here's what that path towards home ownership looks like. This is our 6 steps of home buying. Probably one of the more important areas of our class tonight, because I get a lot of questions after we wrap up classes, is like, where do we go from here? Like, I'm excited, I want to do something, I want to see what buying looks like for me. This is kind of the roadmap to home ownership. And after tonight's class, we can hopefully get connected for our free consultation where we can design options for you around home ownership. I do a 30-minute virtual session with all of our clients, and that's where we meet on Zoom just to go through and show you exactly the outline of home buying for you. Now, once we kind of figure out what the design and game plan looks like, then the output of that discussion is to essentially have you pre-approved. And that pre-approval can help you go out and start actively looking the market, or it just gives you just a baseline for home ownership and you have it ready to go. So maybe next year when you're ready, you can start acting on that. The pre-approval can be always recertified at any time, but typically it's good for 60 days. So we build your plan for home ownership. And then step 2, when you're ready, is to start going out and house hunting. That probably starts online. Maybe some of you in class tonight have already started that search. But when you're ready to go, you'll start that search online, and then you'll eventually kind of transition to more of like viewing open houses and working with a local realtor. We do have preferred realtors that we work with all across the country. So if you do need a resource, we can get you connected after that free consultation. I get asked often, like, Jason, how long is it going to take me to buy a house, right? I would say probably the longest stage in the buying process is right there at step 2, because you may want to be in a certain school district for your family. You may want to be in a certain community for lifestyle. You might want a certain size home. All those changes and those dynamics can affect how long it's going to take you to find the right home. And of course, depending on what housing market you're trying to buy in, there's more supply in other markets or some markets than others. Now, eventually you'll find that right home that works for you, and you'll be working with a realtor to basically submit an offer to the seller. Now, when you submit an offer, it might not get accepted on the first time. It may take 2, 3 times, maybe 4 or 5 times. But eventually, once you have a offer that gets accepted by a seller, then you move to step 3. So you have a ratified contract, has all the terms and conditions of the agreement with the seller. The day you get that accepted offer, I'm going to give you a call and say, hey, congratulations, you did it. Your offer is accepted. I'm going to walk you through the next steps of home buying. That'll also include getting you scheduled for your follow-up video session. So we'll get a chance to go through all of the final design work of your financing. There'll also be some action items on your side. You'll be completing action items with your homebuyer checklist. You'll be doing what we call an earnest money deposit because the seller, as part of your contract, will want some type of good faith deposit. Usually that deposit equates to 1 to 2% of your purchase price, but it will count towards your total out-of-pocket of closing costs and down payment for your home purchase. In most contracts across the country, there's stipulations in the contract for what we call contingencies that allow you to do some investigative work on the property to make sure the house appraises for what the house is you're buying it for. And we'll help with that as your lender. You'll get inspections done. Your realtor will organize those inspections. We want to make sure that you get a home inspection done. Maybe you want to get the roof checked out, the plumbing, electrical, whatever the case may be. And then, of course, get your loan approved. And as your lender of choice, we'll help you with that as well too. So there'll be some timelines on that contingency period. It could be as short as 7 days. It could be as long as 30 days, depending on what is negotiated in your contract. Now, from the date that your offer gets accepted to the date you get your keys and you're firing up your moving truck, it's usually about 30 days in most parts of the country. Some hyper-competitive markets, it can be short as 14 days. Other markets where it's a little bit slower, it can be as 45 days is the norm. So it really varies based upon what's negotiated with the seller, but really more typical is like what market that you're going to be purchasing in. Step 4 is going to be a lot of just the back end administrative tasks in the financing. We're going to be doing things like verifying your employment, verifying your assets. We're going to make sure your application is all fine-tuned with the right product. Now, one of the things I wanted to point out to you is that, interest rates, which we've talked about throughout tonight's discussion, is that they change throughout the day, through the trading days. So the markets just closed at 2 o'clock Pacific time. They closed at 5 o'clock Eastern time. And interest rates will change during the trading cycle. So as you're in escrow for your home purchase, we're going to be very strategic on when the timing is to lock in your interest rate because of that change in the volatility in the markets. You're going to be getting disclosures throughout the process of what your financing looks like, and that will come after we do your follow-up video session. So I meet with all of our clients once they're under contract with the seller within a couple days after that accepted offer. Step 5 is going to be the loan approval process. That's just meaning your underwriting approval has been done. It usually happens in the first 10 to 14 days, depending on your contract period. As I mentioned earlier, you're going to be getting disclosure sent to you throughout the process. But at step 5, you get what we call a final closing disclosure. And it basically kind of trues up all the numbers in the transaction and gives you a 3-day cooling off period to make sure as a consumer that you feel good. Like, this is exactly what I expected. There's nothing that's kind of moving on the numbers or whatnot. That that closing disclosure goes out to you and gets acknowledged. And then after the 3-day period has elapsed, then we get to the very final stage, and that's called closing the loan. In most parts of the country, we do everything on the same day, which is you sign documents with a public notary, you wire in your final funds, and we wire in your loan funds all in the same day. And the transfer of ownership happens that day. Some states like California, for example, it happens with signing on one day and then funding the loan the next day. But it just depends on what market you're in. But at the end of the day, once we close the loan and everything has been recorded with the local county recorder's office, then you become the new homeowner and get a chance to celebrate this massive accomplishment for yourself. Get a chance to go in front of your house, hold up the sold sign, whatever you want to do with your realtor. But it's obviously a huge, huge day of celebration. And of course, that day that happens, I'm definitely going to give you a call and say, congrats, you did it. I think it's important, though, too, in this journey, our relationship with our clients doesn't end there. Part of what we do with our clients is helping them as they transition into homeownership with our aftercare program. You've heard me talk a little bit about refinancing. So when rates start to cooperate a little bit, and maybe we can refinance at a lower rate that's at least 1% better than you're at today, we want to keep you top of mind through our Rate Watch program, help give you tools to track your home equity and accelerating payments on your loan through our HomeBot system, and then always checking with our clients at least on an annual basis just to see how you're doing, how you're easing into homeownership, and how we can basically continue to serve you on this journey. So that's kind of what the buying process looks like. If you're thinking about maybe considering around your ideas around homeownership, obviously I'd love to be able to partner with you and just kind of understand and help educate and coach you up in homeownership. Our process is really simple. It starts with a simple online application. We do a soft credit check, as you heard me mention earlier. You'll upload some of the requested documents, and then you use our scheduling system just to schedule a really easy 30-minute virtual session. Our goal is not there to sell you in homeownership. It's just to be an educational tool, just like this class is a learning environment, help build a plan for you so that you're ready to go whenever you feel like you're in a really great spot, that it's time to act on homeownership. So look forward to hopefully getting a chance to do that with you guys. This is what we'll talk about in that free consultative service. So we're talking about, where do you want to buy? What do you want to buy? Budgets, cost structures, credit review, give you some tips on really helping improve affordability for yourself. So I look forward to hopefully obviously getting a chance to do that with you guys. And as we wrap up our session, we have a few more minutes left, but we do embrace technology in our process, whether that's mobile, some of our AI tools. So you can start the process all through mobile. But what I always like to share with our class is this is a big financial decision. So it doesn't replace the human touch of our business. It's not an AI tool that can help solve these problems for you. It's really us being experts in helping you on this journey. So we always are connected with our clients, whether it's calls just to talk through things or texts or emails, whatever the case may be. We want to make sure that we're accessible for our clients. Last thing I wanted to point out to you, part of our UVA alumni community, we also pass along discounts in our closing cost structure. Of course, you have access to our free classes at any time, but we always discount our services to create the best affordable option and financing tool for you on this journey. If you've liked tonight's class, we'd encourage you to share some of this with your friends, family, your colleagues. We'll have well over 50 classes that we'll teach throughout the year, have 10,000 people sign up for these classes, but there's other partnerships that we have throughout the country. So, if you ever want to have your colleagues check out some of these other events, love to be able to have them attend. And then lastly, just wanted to share with you guys my contact information. So feel free to reach out in any one of those ways. I'd love to be able to connect with you. And you can also do that on social too. We love the stories that our clients share about their experience with us on our socials, whether that's on Instagram and some of the testimonials or Google reviews or in the Reddit community. Really proud about what our community say about us and how we serve them. So thank you so much for being a part of tonight's class. We have a few minutes left in our hour block. So I just want to open it up for any questions you have. I know I've taken a couple of questions throughout the class, but just want to make sure that we're open and be able to answer anything that you guys have as we wrap up tonight. Any questions that I can help answer, guys? I know probably in some markets I'm just in front of dinner time, so I understand that. We want to get to dinner, so all right. I think we're good. I think maybe. Oh, we got one. Okay, let me answer this question. Curious what you see as the benefits of getting a mortgage with your company versus like a Wells Fargo or wherever we bank. Okay, great question. My job is not to sell you on the APM platform, but I think it's important to educate you too, because there's 3 different channels you can go into getting access to financing for homeownership. One is there's the broker channel, which is basically you're paying a middle person to basically facilitate trying to find you financing. There is the big banks like the Wells Fargos, the M&Ts, whatever, Chase Bank, you can go there, or you're kind of a bit of a transaction there. You're kind of the number in this massive system. And then APM's kind of right in the middle. We're a mortgage banker, a direct lender. So we do a lot of the things that Wells Fargo does in terms of the funding platform, but it's just more high touch in our world because it's a relationship with our clients, not just a transaction. That's why we've had clients over 15 years that are just repeat clients. So we're kind of just right in the middle at APM. And, there's a reason why we get a chance and have the pleasure of getting a chance to partner with awesome communities like the UVA alumni community, just because we're just a trusted resource in our local markets. So hopefully that answers your question. Yeah, and just most lenders are not doing educational classes like this. We just find so much value for our communities, and we just want to kind of pour as much information into our communities as possible, and then hopefully kind of everything else kind of takes care of itself. Right. Thank you for that. I think I'm good on my. Oh, let me. I'm getting ready to. Okay, cool. All right, you're welcome for that. All right, awesome. All right, you guys have been a great class. I appreciate the time. I hope to have a great rest of your spring. I guess we're almost summertime, so hopefully we get a chance to connect here soon. Have a wonderful rest of your evening. I'll see y'all soon. Good night.